And we'll cap it off with one of the bigger upside movers in energy in the regular session today. Shares of oil and gas exploration and production company Magnum Hunter Resources bucking the trend higher, around by about 5%. The company is focused on developing assets in the U.S. and Canada and has a big focus in shale plays in the Marcellus, Utica, and Bakken regions, among others. That moved today higher, Kelly, despite the drop in crude oil prices. Back over to you.
All right, thank you, Dom. And on that note, speaking of which, that was just today. Magnum Hunter stock actually up almost 100% in the last 6 months, while oil has seen a loss of about 12%. Investors pretty thrilled with the disconnect, but why is it happening? In a CNBC exclusive, I'm now joined by Gary Evans, no relation. He's the chairman and CEO at Magnum Hunter Resources. Thank you so much for being here.
Well, thank you for having me.
What have you done to decouple your share price from the oil price and frankly, some of the pressure natural gas has been under lately as well?
Well, you know, natural gas actually, with this cold weather we've had over the last 60 days, is up about $1 an MCF. And so our company today is about 45% oil, 55% natural gas. But we're big believers in a couple of plays that are very active up in Appalachia, being the Marcellus and Utica. And I think we've built a large acreage position that's turning out to be in the heart of the play. So that's what's got our investors excited about the company.
And what crude oil price are you modeling to make those projects work? And what happens if crude oil, for example, in the U.S. falls below $90 a barrel?
Well, most of our crude oil presently comes out of the Bakken, and the Bakken crude oil is, we have about 7,000 barrels a day, and works pretty well down to about $75, $80 a barrel. So we do a lot of commodity hedging, which locks in those prices. So we're pretty well locked in 2014 at about $93 a barrel. So I'm not too worried about it this year, and we're actually in the beginning of divesting some of those assets because I'm very bullish on our gas properties over in the Marcellus and Utica.
I'm curious as well why you're diversifying away from the Bakken towards the Marcellus, the Utica, and Appalachia more broadly.
It all boils down to rate of return. I mean, my job as CEO of the company is to deploy capital in those properties that generate the highest rate of return. And up in the Appalachia Basin, we're getting, on some properties, over 100% IRR and drilling a well. Typical returns up in the Bakken are 30, 40%. That's very good for most companies, but if you've got a large position like we do and you can concentrate in an area that generates those kind of returns, that's what will drive the share price.
Are you worried about the U.S. exhausting its own resources first if some of those Bakken returns are falling the way that they have, and Appalachia, I would guess, over time will fall to a similar rate?
I've been in this business 30 years, and the last 5 years, it's been unbelievable what this industry has been able to do for this country. With the advent of horizontal drilling and fracture stimulation technology, we're able to find oil and gas hydrocarbons in shale plays that we never dreamed possible just 5 years ago. So we truly are going to be able to make this country energy independent. We'll be able to not only export natural gas with the LNG facilities that are being commissioned, but this country will be in a position to export crude oil in our lifetime, undoubtedly.
But Gary, you know that in fact that would ironically make us more dependent to some extent on the global supply and demand picture. So the extent to which the U.S. is opening export markets means that consumers here might pay a higher price if it moves up towards the price that they're paying for oil in other parts of the world.
When in reality, we're dependent already on what's going on around the world. I mean, crude oil prices are dictated by OPEC and demand by third world countries it hasn't really anything to do with the U.S. Now, natural gas is a different story. North American natural gas is a captive commodity here in the United States and Canada, but with LNG, we should be shipping this worldwide. I mean, it's crazy for U.S. companies to be selling their gas for $3, $4 an MCF, right, and the Chinese and Japanese be paying $12. And so the Australians, they're a good 7 years ahead of us with all the LNG facilities, and they're able to export natural gas $6, $7 an MCF. And we should be able to do the same. But the beauty of finding these hydrocarbons like we have is we've been able to attract all these chemical companies and fertilizer companies back to the U.S. because they have a good long-term cheap supply, which drives unemployment down, which drives new business all over the country. We're seeing just an advent of all new cogeneration being built, replacing the dirty coal. So all this is very good for our country.
It's a fascinating story. Thank you so much for sharing some of the details with us, and we'll be watching for certain this year as well. Gary Evans joining me this afternoon. We know everyone who breaks